Good morning. Welcome to this new podcast. I'm glad you're here. Let's talk about personal finances and money and the future of what this podcast can really be about. I'm curious, right at first, if you're tuning in to a personal finance related podcast, what do you want to talk about exactly? What do you want it to include? Should we talk about things like financial products? Should we talk about things like finance theory in general? Like, why are we investing? Why do we care about money? How much money do we really need? Our motivations behind all that? What do you think? Leave me a comment right now. So this is the first in hopefully a long series of podcasts where I can go more in depth with you on a personal finance concept. Maybe on the news, maybe on something that just doesn't really fit into a normal shorter video. But because you and I have time while we drive or do other things, we can make a long podcast. So I'm heading back from a side gig, going back towards work, and I've got a 40-minute drive through traffic, so join me. What I initially had started this podcast episode doing was, my plan was to say, hey, I'm not going to make really these big theoretical, philosophical, long-winded videos reviewing a book and talking about what the book really means and having a 25-minute video, because frankly, the people that are here don't want to see that. But if we make that into a podcast, maybe that's something more doable for me and more palatable for you. So I think that's going to be the way going forward, because I want to share these bigger concepts with you. I just have a hard time doing that and making it worth all of our while elsewhere. So I think the podcast is such a natural fit. And a little inside baseball for you, whenever you put a podcast on YouTube and you have it labeled as a podcast, they sort of separate it and put it in a different folder, if you will, than the rest of your videos. And so what that means is these are kind of treated differently, where if I made a big long video on a normal part of my channel and it didn't get great views, then they'd be like, we're not going to recommend this guy to anybody. So this way, if these don't get a lot of views, but it's impactful to a few of us, you get a good result personally, but I don't get a negative result through the YouTube algorithm. So win-win. And I was going to do this through YouTube memberships, and I decided that was not the way forward, because frankly, I don't think it'd be worth paying any money for. And so we're not going to do YouTube memberships because I don't like that. So here we are. Free stuff for you all the time, all the free stuff. Let's talk about what it looks like to be in November, December of 2023, because my gosh, it snuck up on me. It's always that way though, right? You're suffering through summer, at least here in Arizona when it's super hot. You're suffering through going, when is this going to end? When are we ever going to have a break in the weather? I want it to be fall. I want to have beautiful, nice weather. And then before you know it, it's like, October's here. Halloween's here. Thanksgiving, Christmas, boom, the next year. And you're like, what happened? How did this happen so quickly? And we're already in the midst of that now. So by now, there's a lot of other things occupying our mind besides just like, gee, what should I do with my money? Or what's the future? Or how do I get more income at my job so I can have more money, so I can invest more? And how do I invest better? And how do I get started in this? And all these kinds of typical questions we might have during the year. Because now we're full of thoughts about the end of the year, holidays, seeing friends and family, doing all these events. I'm going to have to spend a lot of money buying gifts. Like, we just think about, I think, different stuff at the end of the year. And so I know some people do end up thinking about investing again towards the beginning of the following year, because just by like the search traffic numbers and the analytics that I can see, I know that people do that because we're thinking new year, new start, new goals. Maybe you haven't started investing yet, and next year is going to be like the time to start. And so that kind of stuff does start to tick back up. But for now, I think a lot of us are just consumed with like our schedule, what's happening. So if I want to do better, I was going to say, let me give you some tips on how to do better. I'm going to talk personally and say, if I want to do better than I have in years past about my self-control and spending and planning wisely for the holidays, for all my resources, not just money, but also time and energy and health, how can I do that better? I know in the past, one thing that has helped me a lot is to schedule things on the calendar, A, really far in advance, and B, regardless of how kind of minor and petty they might be. So it seems kind of silly to look 2 weeks ahead and go, well, let me schedule a run. I will set up my runs to happen on Saturday mornings at 5 a.m., blah, blah, blah. But the realistic thing is, unless you block out that time for the thing to happen, it's not going to happen. So for us to continue to be healthy people throughout this busy holiday season, I think let's schedule out the things that really need to happen. I should schedule a date in December for my wife and I, like today. Find a babysitter, make it happen, lock it down. Because otherwise it's just not going to happen. Yeah, we will technically see a good amount of each other because we're going to be doing holiday stuff together, but that's not quality time. And quality time is important to me in my relationship, so I need to make that kind of happen. This jacket's getting hot. So if I'm going to do that, I need to schedule things out. To a similar degree, planning out holiday expenditures could be wise too, because even if, let's say you're not going to go like full monk mode and be super frugal and hand make everyone's presents to save yourself some money. Let's say you're still going to spend the same exact amount of money that you did last year. At least knowing ahead of time what that's going to be, how much you spent, and having a plan for this year could make that easier to manage and easier to plan for. So the way I do this is I have a spreadsheet. Of course, I love a spreadsheet. Spreadsheets are the best. And I've listed out, I said 2022 gifts, and I basically had my wife's side of the family, my side of the family, and I listed out by name, hey, this person got this gift, bought from this retailer on this date for this much. And then we had a sense of like who was left to buy gifts for, so that was helpful. It was like a checklist situation. But then also now, a year later, I have no idea how much money we spent on gifts. Less than 1,000, I would think, but more than 500. And so to have all of that in like a record and go, okay, this is what we did last year. I feel good or bad or indifferent about that. This year we're going to do something similar. Who do we have left? How much do we plan to spend? Because there's just going to be a lot of activity happening in November and December. And so for those of us in the first world to be able to plan this out and go, all right, well, realistically, I've got to have an extra $900 in the checking account ready to be drafted by this credit card company by the time that rolls around or whatever it is. I think it's going to help us a lot. And it just helps me hopefully alleviate stress overall, because I think the further ahead we can see things, the earlier we can get them done, the more I'm hoping that frees me up to actually be present in the moment. The point of having money is that it alleviates all of the problems that money can alleviate. So it can buy you time, it can buy you space, it can buy you health in a way, because now you have time to exercise or you have a person to help you be more healthy. And the point isn't like, oh great, I've got 10 grand in the bank. The point is, how can I use my money now, let's say to hire a landscaper, to free up my time on a Saturday, to go on a date with my wife, go Christmas shopping, knock all this stuff out in November. Then December comes, we can just hang out. We can just enjoy time together. We're not rushing around. We're not trying to logistically make stuff happen. One and done. I don't know how this turned into like a holiday shopping podcast. It's not what this is. This is a personal finance podcast. Let's dive more deeply into personal finance things. So we're in an interesting time because the stock market has rebounded from the last couple of years during COVID when it was having a hard time. And it's done fairly well this year. I think we're up something like 7% this year. And that's great. I love to see it. Our accounts are growing again. They're back at all-time highs or near all-time highs. And while that's good, we as people who have money invested, or we as people who are interested in the world of money and how do we optimize this and how do we be as wise as possible with our money, we actually have a weird conundrum right now. Because what we're dealing with on a small scale personally is basically the same thing that big companies, big investing funds, and rich people are also dealing with, which is investments aren't as attractive as they used to be because the returns haven't been that great, but also they're not as attractive because bonds and savings rates and more secure, safe ways to deploy your money and get a return back are so much more appealing now. Because let's say in 2012, 2018, any time around there, bond rates, savings account interest rates, anything like that, CDs, they were just so unappealing. We were talking about 1%, 1.8% interest. It was peanuts. It was nothing. It was worth avoiding. And so everyone invested. And lots of money flooded into the investment market in the terms of stocks, in the terms of real estate. And it was a viable option for everybody, and things were growing. And now just the opposite's true. Because those interest rates are so much higher, and because the cost of borrowing is now so much more expensive, it's difficult for people to pencil out those numbers and make other kinds of investments and make things grow. Because like what I see here locally in Arizona as a construction manager, as someone who builds commercial spaces for big national brands and big corporations, is they're pulling back on their plans to expand. I think a lot of people, a lot of companies had these big goals to say, hey, we're going to build X number of stores, we're going to deploy X numbers of $100 million, $200 million, we're going to do all this expansion, which adds jobs, which adds growth for everybody. And now, because the money is so hard for them to borrow and have their deals pencil out and make any financial sense, they're going, I don't think we're going to do that. I think we're going to wait. And so a lot of deals in the real estate side that were inked or were planned or were almost done are now basically getting reworked or getting pulled. And so what that means for me and for a lot of us in the construction world, and everybody who might have gotten a job at those places or might have had an ancillary business around those places, if you're a cleaner or a window washer or a service person or a food delivery person or whatever, we all now have to realize that we're not going to have that base of business for the next 12 to 18 months. We're not going to have that recurring business for anything happening with them after that point. And so we're kind of girding our loins, if you will, for a potentially rough next 12 to 18 months. What that means for the stock market, I frankly can't correlate. I mean, this is talking about short-term activity that's going to happen in the business world or not happen in the business world for the next 12 to 18 months. And I don't know what that is going to tell institutional investors and super rich folks who can move the stock market with their purchases, and what their opinions will be that shift and shape the stock market. I don't know what that looks like. Excuse me. But what it looks like for us short term is that it's going to slow down our core business, and it's probably going to have a ripple effect elsewhere. Difficult to point out what that is, but there are some people who think that we've got a big problem coming up just in general, because there's a lot of people out there who are just normal folks who did things like buy cars with adjustable interest rates. During the last 3 years, and because of pandemics and chip shortages and strikes and international conflicts that reduced parts availability, what happened was it got really difficult to build vehicles. And so as a result, the demand went up, the supply was down, and people were kind of frantic to get into cars, and interest rates were still pretty low. I mean, 3-4 years ago, interest rates were still reasonable enough that I think a lot of people signed up and thought, this is fine, I can do this. And maybe or maybe not, they realized that, hey, an adjustable rate loan on this is suicide financially. But now they're into it. Those rates are obviously climbing and climbing and climbing until people are at a 7, 8, 10% interest rate on their car loan easily. I mean, those are decent rates. Those aren't even like the worst, because if you do something like a buy here, pay here car loan, then you're going to get really screwed. And now all of a sudden, those cars are just not affordable. And the problem is too, whenever you've got a car loan, I saw this when I worked in the car industry, when I was a salesman, and then when I was later working more on the back end at a car dealership. The problem too with a high interest rate loan on your car payment is that you are paying down less of the equity of the car and just putting more money into the lender's pocket. So like, for example, we had a guy come in once who was just distraught. I mean, I honestly felt bad for the guy and wanted to help him. It wasn't even like a money thing at this point. He was just buried in this car loan because the truck that he had bought was worth something like, I don't know, $17,000 or $19,000. Wasn't a terribly old truck. It was still pretty new and pretty good shape. But the problem was that he owed like $32,000 on it. So we were talking about 12, 14, 15 grand apart in terms of what the truck was worth versus what he owed. And so in that world, they call that being underwater. So he was upside down, he was underwater in this loan. And at that time, banks weren't loaning over and above the value of the new car you were buying. So I know at times in the financial industry, they've allowed you to borrow 110%, loan to value ratio. So let's say you're buying a truck for 50 grand. If they're willing to loan you 110%, you can actually take out a loan for 55, even though the truck's only worth 50. And in those cases, people are sometimes able to dig themselves out of these upside down loans. You just keep rolling it into the next loan, roll it into the next loan, and hopefully you catch up. You pay off enough of the equity of a vehicle and keep it long enough to then get leveled out and maybe even have equity in the vehicle. But because this guy had some obscene interest rate, I think it was something like 19%. I mean, whatever it was like sickening, because he went to a local buy here, pay here car place. He was just unhelpable. And he was basically in tears going like, I've got to get out of this truck. The payment's too high. It's not worth this. I'm getting financially ruined by this thing. And I don't care what I get into. I just have to get out of this. And we couldn't help him because the banks won't loan that much money to fish you out of your own problem, if that makes sense. And what's going to happen is a lot of people are going to be in that same situation right now because they're in these adjustable rate loans. The interest rates are going to be decently high for everybody, but especially if you've got an ARM that's like, well, not an ARM because it's not a mortgage, adjustable rate car loan, and that rate goes up to 12 or 15%. I mean, this is a really rough time to pay off debt then. And so what a lot of people are forecasting then is that there's going to be a lot of car loan defaults. The car loan defaults have already risen to a level that's really, really high, even as we speak right now, like November 10th, 2023. So how that then ripple effects, let's say that happens and keeps happening, how that then affects the rest of us and the rest of the world and our well-being, difficult to say. But all of that to say, there are potentially rough waters ahead for the next 12 to 24 months in terms of several factors in the world. But there's a big problem with all that. The problem with claiming that there's rough waters ahead is that there's always potentially rough waters ahead. And there's people in the YouTube comments, there's people in the financial space, there's financial experts, there's people who are paid to do this large sums of money to just talk about what the future financial markets might be. And they are regularly preaching doom and gloom. And the weird thing about that kind of pessimistic, weirdly like one-sided mindset is that at some point they will be right. At some point, yeah, things are going to go way down and they're going to be like, I told you so. I've been saying this since whatever date that things are going to be crashing and everything's going to go to crap and we're all going down, blah, blah, blah. And that's not a useful prediction because it doesn't equip us to do anything at the right time because they've been saying it for forever. Like, I've got one friend. I doubt he will listen to this. And he's been saying since like 2018 or something, oh man, I think the stock market's going way down. He's buying these particular investments that short the S&P 500. So if the stock market as a whole kind of drops, then he would make money. And he was just sure because of whatever indicators he was seeing, oh man, we're in for a wild ride. It's going way down. And of course, it hasn't really done that. Like, we had a technical recession with 2 negative GDP quarters and the stock market went down and things have dipped and then they came back up. But there was no big like fall from grace like he was anticipating and expecting and literally betting his money on. And so it's kind of funny because the doom and gloom people are like always wrong until the one time that they're right. So I don't want to be one of those people because I don't think that's a useful perspective to have. And frankly, I think it's wrong at least 90% of the time. And the right perspective is to say, we have reason to believe that there will be growth and reason to believe that we ought to be investing more and, to keep doing what we've been doing, basically. As I try and change lanes here and don't get hit because there was a car accident or something. What happened? This person has a flat tire or something. Oh my gosh. Oh yeah, no. A 4-car accident. A 4-car pileup. Oh boy. And that, folks, is why we need to leave more space in between cars. If you're in America right now and you're driving and you don't have at least 3 to 5 car lengths between you and the vehicle in front of you, you're tailgating. You're too close and you're gonna have a situation like those people did where they were all driving too close, someone had to hit the brakes, no one had time to react, and now you've got 4 cars that are all involved in an accident, slammed into each other. That's a problem. I had a similar thing happen. I got in a car accident was that this year? I think it was earlier this year, where traffic came to a halt. I slammed on my brakes, and at the last second, a car jumped in front of me. And because I was already slamming on my brakes, I couldn't stop anymore. And she jumped in front of me at the last second, like as I was braking, and took up that space between me and the vehicle in front of me. So I slammed into the back of her. Her insurance company came after me and said, "You hit the back of our client. Of course, you're at fault." And thankfully, I use a dash cam. I have no sponsor for this. This is not an ad read. And I sent in my dash cam footage to my insurance company and said, "Here's what happened. You can see right here that this driver of this other vehicle was already tailgating people, changing lanes aggressively, not making wise decisions. And then here at the last second, as cars are stopping, you can watch the taillights, boom, 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 get closer and closer and closer to us. Then she jumps in front of me at the last second because she couldn't stop in time from the car in front of her, and then runs into the back of me. Or I run into the back of her, sorry. And so they were like, "Yep, nope, we appreciate this. You're totally innocent. If they ask us for anything, we are not paying them a dime, like they are at fault, yada, yada, yada." And so now, I mean, I always, in theory, trusted that having a dash cam would save me, just because that accountability I want. I'm confident enough in how I drive that I am okay being filmed all the time. And so I want that accountability, and use this thing for probably 3 years before it ever came in handy. And then boom, there it goes. Completely saved me because I had a record. So that's a separate kind of financial discussion, having accountability on your side and being able to deploy some accountability towards other people whenever they claim that you did something wrong to them. No, actually, I have evidence. And it's cheap insurance, right? I mean, a dash cam is like $65. But anyway, back to the financial markets and investing, and what can we do with our money wisely to deploy it and grow it and keep track of it now. I think what that means for me and what the short-term financial markets look like, I have no idea what's going to happen with the stock market in the next year. I think in the next 20 years, I'm still confident and bullish and optimistic, and so it doesn't change my long-term plans. We're still investing. There's still automatic withdrawals coming out of our bank accounts every month, and I'm happy with that. But for the short term, in terms of what do we do with cash on hand? Because we've got, I don't know, I mean, in different forms, technically like $40,000 in cash. Some is in the bank, just as like a revolving door of checking account in and out, paying off, normal living expenses. There's $10,000 in I bonds, and I did a video on that on this channel where through Yada, whenever they offered I bonds, I maxed it out for the year for myself and said, hey, I'm going to do $10,000, because at the time it was like 9.63% interest, and that's just amazing. But that interest rate changes every 6 months. And so now it's way down to 3.6% or something like that. So that's technically still riding there and being an I bond. But I might take that money out if the next I bond rate updates and isn't any better. Because I would have thought that I bonds would have tracked with a lot of other interest rates and been decent, but it's not. 3.63% is pretty atrocious. So if that stays down, then I might withdraw that money and have that cash to do something with. And then we've got about another 20 that's sitting there in M1 Finance in their high yield checking account. So I think for me, the most liquid and appealing thing is just to use a high yield savings account. I'm sorry, I said high yield checking account with M1 Finance. It's a high yield savings account because they just closed their checking account. They've no longer decided to add that service. That service is gone for M1 Finance. But I met with a buddy and talked about this and said, look, if you're sitting on a lot of cash and you're not using a high yield savings account to get at least 4.5%, then you're just missing out on free money for no reason. Because there's no risk. It's a checking account or a savings account or a CD. It's like these couldn't be safer financial vehicles. Transfer your money from the Wells Fargo of the world or the Bank of America or whoever the big bank is that's not offering you an attractive interest rate over 4% to a place that is offering an attractive interest rate over 4%, and just let the cash sit there. You don't have to invest it. You don't have to risk it. You don't have to tie it up for any period of time. It's just there making you more money in between now and then. And so with M1 Finance right now, with their M1 Plus account that we're paying for, I think it's like $90 a year to get added features, higher interest rate through their high yield savings, to get a cheaper borrow rate if I wanted to borrow against the stocks that we own, that kind of thing. We're making like $99 a month on our cash just sitting there. So in 1 month, the premium pays for itself, and then everything else is gravy after that. We're essentially making $1,100 a year in completely risk-free interest in this high-yield savings account. So I would say, for me personally, if I take my money out of iBonds, the high-yield savings account is the next best option because it gives you all the liquidity you might want if you need to take that money out and do something with it while giving you a nice high interest rate. The problem with that is it's sort of the inverse of the adjustable rate car loan. And what that means is if the interest rates go back down to the point where they're only earning 1 or 2%, then now you don't have that benefit of having that money in there. So what I'm tempted to do is to rip the money out of iBonds, to pay the 3 months of interest penalty for having taken the money out early before 5 years, and then roll that into something like a 2-year CD and lock down something like a 4.8, 4.9% interest rate on a CD and say, hey, this money is sort of a rainy day emergency fund, someday fund in case the kids grow up in 12 or 15 years and need a car, like whatever that looks like. It's technically still cash, but it's earning an interest rate that's way more attractive than most cash in my lifetime ever has. And so it's still worth deploying in that way. Am I confident enough in the next 12 to 24 months to just invest all that money? I want to be. It's like one of those things where you're like, I want to be healthier. I want to exercise. I want to eat healthy. I wish I had kale every day for lunch, but I can't force myself to do it. I don't think I can force myself to be that confident in the interest rates or in the stock market and what that return will be for us in the short term, because I just don't know. But the majority of our net worth is still invested in the stock market. So it's not like I'm selling anything there. I'm not withdrawing money from investment accounts. It's sitting there nice and pretty, and it's in there for the long haul, right? So I don't know where that leaves you, because maybe you're sitting on over $100,000 like my friend, and frankly, you can benefit a lot from just shifting some cash around and getting some higher yield interest rates on your cash savings. That could be really worthwhile. Also, what I hear from people that haven't really started investing yet is like, when's the best time to start investing? How low do I have to wait for the stock market to go to start investing? And I just think that's asking the wrong question. And that's not a dig on you. If you've been asking that and you've been sitting on $20,000 and you're my age, you're 36 and going, I don't know when to start investing. I don't want to get in when the stock market's too high. Here's the deal. In history, the stock market has always gone up since its inception. In the short term, in the terms of like a year or two, not always true. In the terms of 10 years, 95% true. And in 20 years, 100% true. So what we have to just do is zoom out our perspective and go, don't worry if the stock market is volatile in the short term. I'm preaching to myself here. Instead, look at the long term, at the macro view, and say, are you going to be planning to use this money in the next year or two? Don't invest it. If you're going to be planning to use this money for retirement for 10 or 20 or 30 years from now, investing has always been a wise decision then. Investing has always paid off. And the beautiful thing about investing in the stock market is it requires nothing of you ongoing. I fully realize and accept and believe that the fastest way to grow your net worth is to go through ownership, to have equity in a company that you're building or helping to build. And that way your growth of your actual worth is happening as fast as possible. But the problem with that is it requires so much sweat equity to make happen. Sweat equity meaning work that you're putting into it. If you're at a startup company and they're giving you shares in the company as part of your compensation package, that's because you're working your booty off to earn that equity in the company. Then someday if the company gets acquired, if it goes public, whatever, then you have this promise of a big payday because you have equity in the company that you've helped to build. And the same thing applies to a business that you're building yourself. Let's say you're starting a window washing company and you hired your first employee and you've got plans to grow over here and you've got a cousin in Las Vegas that's going to open a company there for you and you have all these growth plans. Well, you have equity in that company then that stands to grow your net worth. All of that requires a ton of hands-on, hard work, long hours, high risk. The reason why I love the stock market is it requires basically none of that. It's hands-off. You set it and forget it. You put the money from your bank into the investment account, and then it's done. I don't have to work on it or think about it, because all those people that are in that company that I've invested in are working for me now. Those people that are the employees of Jeff Bezos or of Elon Musk or of, who's the Apple guy? Tim Cook. All of his employees are now kind of like my employees. Because I'm a shareholder, they now have to grow the value of their company to please people like me. So it seems like a weird power move to say it like that. I feel like a little gross describing it that way. But that's true. I mean, that's how the stock market works. Those people are trying to grow their companies, and then I will benefit from that while I'm sitting here driving in a car talking to you. So I think that's the coolest part about it, is that it's so hands-off. There's more risk there than there is in a high-yield savings account, but there's less risk than there is starting your own business and going all in on that. So my battery's about to die. So I think we're done. I gotta go. See you guys. Have a great day. See you next time. Appreciate you. Bye.